Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of the current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:40 a.m. Central Time, and I'm recording this in preparation for the market day of September the 22nd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's dive right into the overnight action on our morning report. We had quite a bit, and indeed, we've been flirting with being down 30 points on the S&P futures, or almost 1.5%. Russell's also down 1.5%. Nasdaq's down even deeper at about 1.75%, and then the Dow is down about 1.4%. Crude oil down over 2.5%. You have the euro down about 0.2. Bonds are up about 0.61, and gold down about 0.4. In overseas action, China up almost 1%, Hong Kong about 0.2%, Japan going the other direction down almost 2%, and Europe is being hurt big time. Germany is down well over 2% at about 2.4%, and the United Kingdom is closing in on 2%. So not sure at this point why the U.S. is down so much, other than the charts have been telling us to expect this, but certainly it would seem that just in looking at the overseas futures markets, that it seems to be primarily generated out of Europe as opposed to Asia, with the mixed signals coming from Asia. In terms of macroeconomic reports for today, you do have FOMC member Lockhart speaking, and that will be after the market close. He was also speaking yesterday, and I did see some headlines attributed to him. This is a very, very interest rate sensitive market right now, so anytime one of these FOMC members speak, people are paying very close attention. In terms of tomorrow, you have flash manufacturing and crude oil inventories, and again, Lockhart speaking. He is being quite busy of late. In terms of our current volatility conditions, look at the skew here. The skew, when this closed yesterday at 135, that is a warning sign of the potential for a multi-standard deviation move. And certainly at the beginning of the day here, and being down 30 points on the ES futures, or the S&P futures, which is the E-mini contract, you have certainly the leading edge of this expectation. Short-term VIX actually dropped below a 20. I think that's the first time we've seen that in quite some time, 19.61. So that's kind of interesting. We'll see where that closes today. And indeed, obviously, when you have these big overnight gaps, you usually think of this as a professional gap. And let's go ahead and go to this. You usually think of this as a professional gap, and that we're likely to see a gap and go, which is a continuation pattern, or at least to kind of stalemate and stay very, very low. You do not normally expect that gap to fade and close when it is that large. And basically what happens is the professionals who operate 24/7 trap the retail traders, the small traders. They are stuck. They often end up, if they have small stops, they often end up closing their positions, especially at the open. You take a look at those first 5 minutes, especially the first 15 minutes, you'll often see a lot of stop running with a big gap like this, and then we'll look to see, does this have a continuation pattern, or indeed does it start to fade the gap and come back. So do not expect that gap to close today at that size. The probabilities of that are very, very small, but it is something to certainly watch at the open. The other thing is, while we've got this chart up, you notice, and this is on the futures contract, so it's going to look a little bit different than, say, if we throw the SPY. But we've been watching this diagonal support, which certainly would seem to be broken now. We had, of course, the false breakout to the upside, and then a pullback. Now, some have theorized that this is a breakout and then just simple retracement, and that about 70% of breakouts do retrace. You know, that's one way to look at it, and especially if you're thinking that this is still a bullish pattern. I frankly did not like the fact that not only did we have this 3-candle pattern with the tall tail on the top here and back into the area, but that we actually came down, to my reckoning, and closed below the diagonal support. We did have something of a bounce yesterday, but then, of course, with this overnight action, looks to be breaking down and frankly, in my mind, confirming a breakdown below this diagonal support. If this doesn't really quickly today come back up and reestablish a bullish posture, I would expect that the next step is likely to come back towards these last recent swing lows and to visit that area. So we still have, an A hypothesis and a B hypothesis. My A is that we're likely to head down to this area. The B hypothesis is that this pennant or ascending triangle has denigrated, and at the very least it's now a sideways, draw a rectangle perhaps. It doesn't look like a very good rectangle to me quite yet. Yeah, I still think this is simply a broken and failed either ascending triangle or pennant pattern, and that we are now breaking down to the bottom side. If you are a pennant, normally what you expect is a break to continue in the direction of the prior trend. The prior trend here was down, and indeed, if you look at any time frame, 3 months, that kind of thing, this is a bearish bias, and that you would expect this to break in the direction of the prior trend being down. Now, in terms of the short term, the reason there was certainly some credence to the expectation that this was an ascending triangle and that this was going to break up is that in the short term, you take, this is like 3 weeks, the trend is up with higher lows, and that we would be breaking up. But so that you have basically the battle, the short term versus the intermediate term. I would put more weight to the intermediate term until proven otherwise. This looked to be, at the early part of this day, a pretty interesting case being made for the bulls, but then it was totally rejected. And I say early, this spike right here, this tall wick, occurred after the FOMC announcement, but it lasted like an hour, and before the bulls ran out of strength and the bears took over on that FOMC announcement and drove it all the way back down below the open on the futures market for that day. So, and ever since that, other than a little bit of a bounce here, it's been all down for now going into 4 days. So it is pretty interesting to look at that. Now on the SPX, of course, it looks a little different, but very much the same kind of pattern. And on the SPY, on the Russell, of course, also looks to be a breakdown. You see the Pearson's arrow now came in with a signal to the downside. We have NASDAQ, also a Pearson's arrow to the downside. And the same thing for the Dow, Pearson's arrow to the downside. PSARs have flipped. So a lot of technical indicators are coming in to say that this has swung to the downside in the last 2 days. So we'll continue to watch this after the market opens, but some pretty interesting patterns that are setting up. In terms of our regular daily report, not a lot of changes today, but still IBD status, uptrend under pressure, accumulation distribution. This is a little different. It is denigrated to a D minus, NASDAQ to an E. GMI index has fallen to a 0 out of 6. That's a new score there. That author is still in cash. Primary market condition is strong bear. Decision point scoreboards, no change here. Long-term and intermediate term, all down arrows. Consensus of the portfolio posture from these various signals is clearly bearish, though the intermediate term market posture continues to hold on to a weak bull. And indeed, we continue to just incrementally continue to push up ever so slightly. S&P 45.5 now, and the Russell just below, going to all-out bullish at 49.4, while at the same time the Dow and the NASDAQ are already signaling bull market. So on this system, they've been for some time signaling very weak bulls, and they're on the verge of going more strongly bullish. Now, if today's action holds up, I would expect this will flip. In terms of position sizing opinions, based on portfolio investor, 50%. Then in terms of the volatility metric, it's also calling for a 50 to 75%. Hedge warning status remains level 2, and we feel pretty good with that level 2 opinion at this point. That is a red light, and indeed risk conditions are elevated. And while that is not a prediction that the market will fall or to how far it will fall, it's a prediction that conditions are ripe and are elevated that such things can happen. And if they do, they're likely to be met with considerable energy. Some of the individual components here, in terms of the volatility base, the market incline has still been firing, though the short term did fall off with yesterday's action. VIX is still above an 18. Distribution count still remains at a 3 for both the S&P and the NASDAQ. One of the warnings, of course, was the skew is of up 135. New highs, new lows on the New York Stock Exchange yesterday. There were twice as many new highs as new lows, so that was actually a sign for the bulls. And a sign for the bears are the risk aversion indicators we added to the risk off, and we now have 4 of the 5 are flagging as risk off. So that's something to consider. In terms of special opinions, no change from yesterday. Option income strategies, VIX is outside the acceptable window. This continues to be a market for initiation of new option income strategies, really only for the highly experienced, very nimble trader who is accustomed to adjusting and the like. As this market could certainly, with these risk conditions, eat up a delta change or a vega change and require significant adjustments. So this is not a market to put something on and expect that you're just going to take it off at your profit target by just simply being patient and waiting. That can happen, of course, but the elevated conditions would make that probability more challenging for sure. Covered call and put selling, really quite borderline, we said yesterday, and we certainly feel justified in that right now, as the ES or the S&P futures are down some 30 points. Aggressive traders could consider scaling into some positions, either covered calls, ideally through legging in by selling puts and then converting to a covered call on assignment, or consider scaling into positions. Usually better to use defined risk positions, spread that off with your entry, and take very, very conservative, scaled in kind of positions on either one of those strategies given the current market conditions. And then in terms of sector specific, We had some improvement here yesterday, obviously, but that would look to be all nullified today with the current action. If that holds up, I would expect this to all turn red across the board once again. And indeed, yesterday was a fairly decent day. Financials, interesting enough, were up. You see healthcare took a very different direction. And indeed, really what this was biotech. Hillary Clinton came out with some very adverse policy wishes in terms of going after healthcare with price controls of some sort. She didn't yet specify how she would want to do that, but obviously if you're in the healthcare business and somebody wants to limit the price in which you can sell your product after having spent hundreds of millions or even billions of dollars in development in developing that product, that sends a shiver through that industry, and you can see what happened as a result. Keep in mind, while we've had a little bit of bullish action in recent days, the big context still here is quite red, and you see 5-day, 1 month, 3 month, year to date, even 1 year, and the vast majority of these sectors continues to be quite bearish, and you really got to assume bearish until proven otherwise, though we've had some signs that the bulls could actually take this up. So it is clearly a very challenging market, and whether this proves out to be a head fake and this denigrates down, or this proves to be a just a leading edge, and this is just nothing but a retracement before taking the next leg up, remains to be seen. But we certainly are looking for higher lows and higher highs. You could make a case in the short term, but it certainly is being called into question with the action of the most recent days since the Fed announcement. So that should be enough for today. As always, if you find what you're getting from here helpful to your trading, we greatly appreciate you retweeting us to your Twitter followers, to your StockTwit followers, liking us on YouTube, subscribing to our YouTube channel. That will give you alerts as to when these messages are posted each morning. And of course, direct feedback can always be sent to support@falconglobaltraders.com. We certainly welcome that. More information is available on the website indicated here about how we actually apply these principles to our daily trading. Disclaimers as always. Hit the pause button if you need more time to review this. And we look forward to seeing you back here tomorrow morning before the market open with the Falcon Global market preview. Good trading to everybody.